You know that feeling, right? That constant buzz around crypto, all the talk about digital assets, and you're sitting there thinking, how do I actually make these holdings work for me? Generate some passive income, maybe, but without getting totally lost in, the jargon and these super complex strategies. It's a real challenge,
It really is.
especially when the whole crypto world feels like it changes every other week. Keeping up is tough.
Definitely.
Well, today, that's exactly what we're diving deep into. Our mission here is to unravel staking strategies in 2025.
Right.
Because what used to be like a really specialized, almost obscure thing, something only hardcore crypto people knew about, it's totally transformed.
Absolutely. Mainstream now.
Yeah, it's become a mainstream financial strategy.
Mm.
So we're going to break down the three big pillars investors are looking at this year: security, yield, and flexibility.
The trifecta.
Exactly. The goal is to give you, our listener, a shortcut. Cut through all that noise and hype and just give you the key knowledge nuggets you need to navigate this space confidently.
And it's quite a journey we're taking today. We'll start by really getting a handle on that huge shift, how staking went from the fringes right into the financial mainstream. Then we're going to dig into the details, the risks, the rewards that come with making your assets earn for you. So you understand not just what the opportunities are, but why they matter for your decisions, how they might fit your own plans.
Okay.
And finally, we'll look at liquidity. That used to be a massive hurdle, right? A real barrier.
The lockups.
Exactly. But now liquidity's become a total game changer thanks to some really smart solutions. I think you're going to walk away from this with some real aha moments, properly understanding the staking landscape in 2025.
Awesome. And before we jump into that first segment, just a quick note. If you're finding this useful, or, if you appreciate us trying to make sense of all this complexity,
Yeah, definitely let us know.
please do us a favor. Take a second, hit that like button, subscribe to the channel if you haven't already, maybe turn on notifications.
It makes a huge difference.
It really does. Your engagement helps us grow, boosts us in the algorithm, all that stuff, and basically lets us keep making this kind of crypto content for you. So yeah, we genuinely appreciate the support.
We really do. Okay, let's get into it.
Okay, let's unpack this then. I mean, it really does feel like just yesterday, staking was this weird ritual only a few people did. So how did we get from that, from staking being something only the super crypto savvy knew about, to, well, hearing it discussed in mainstream finance circles, like almost alongside traditional investments? What's the biggest takeaway from this shift?
That's a great question because the shift is huge. And it's not just technical, right? It's cultural, it's financial. Staking's transformation, really, it mirrors crypto's own journey towards maturity. A few years back, you're dead on. It was super specialized, almost an exclusive DeFi club. To even get involved, you often needed serious tech chops, setting up nodes, messing with command lines, trying to figure out complex smart contracts.
Yeah, not for the faint of heart.
Not at all. The infrastructure was clunky. The risks of messing something up or just outright failure were really high. And then there was the illiquidity. Your funds could be locked up for months, maybe even years, just stuck.
Right.
Okay, fast forward to 2025. It's a totally different picture. It's a widespread, genuinely mainstream yield strategy. You see it everywhere across almost all the major proof-of-stake Layer 1 blockchains.
Like Ethereum, obviously.
Ethereum's the big one, yeah. After the merge, that pivotal switch to proof-of-stake, now something like, over 25% of all ETH is staked? That's a staggering amount of value securing the network.
Wow.
But it's not just Ethereum. You look at Solana, Cardano, Avalanche, they all have really robust staking ecosystems. And even the newer L1s coming up, they're often building staking in from day one to secure themselves.
So what drove that change?
Several things, really. One, the protocols themselves just got way more user-friendly, better interfaces, simpler processes. Two, the underlying tech, the infrastructure, it's matured massively. Staking services are more reliable, easier to access.
Yeah.
And third, critically, there's just been this undeniable growing demand. From regular folks, from big institutions, everyone wants real passive income opportunities in crypto.
Makes sense.
So the really profound implication here, staking isn't just about securing a network anymore. It's become like a fundamental way capital gets allocated in the digital economy. It's a recognized strategy for earning income from digital assets. It helps shift crypto from being just speculative to being actually productive.
That really clarifies the scale of it. So, okay, if staking's gone mainstream, then investor priorities must have shifted too, right? It can't just be about chasing the absolute highest APY anymore. What's guiding their decisions now?
Exactly right. And what's fascinating, really fascinating, is how in 2025, investors aren't just looking for yield. They're laser focused on this trifecta of interconnected things: security, yield, and
I
flexibility.
love the trifecta again.
Yep. These three are the absolute critical decision points now. It shows the market's matured, investors have a much more sophisticated grasp of risk and opportunity. You know, those days of insane, unsustainable yields from brand new, unaudited protocols, they're mostly gone. Investors are way more discerning now.
Okay, so break down that trifecta. Let's start with security.
Right, security. Look, the last few years, they've really hammered home the reality of custody risk for crypto investors. We've seen so many high-profile hacks, protocols getting exploited, major centralized exchanges just collapsing spectacularly.
Yeah, painful lessons.
Painful is right. That phrase, not your keys, not your crypto, it's not just catchy anymore. It's a hard-earned truth. People are now acutely aware of the systemic risks when you hand your assets over to someone else.
So they want more control or better guarantees.
Both, really. They're demanding robust protection. That might mean better self-custody tools, using decentralized protocols that have been battle-tested over time, or maybe using custodial services that are heavily regulated and audited. The priority now is verifiable security, transparency in how things are run, clear audit trails. That's huge.
Now, it's not just hackers.
No, not at all. It's also about protecting against counterparty risk. What if the company holding your crypto goes bust? It's about regulatory risk. What if the government steps in? Even just operational failures of the service provider. Security is multifaceted now.
Okay, number 2, yield. Still important, obviously.
Oh, absolutely. The drive for attractive returns hasn't gone away, but now it's viewed through this lens of a more mature, more diversified market. People are looking for sustainable, risk-adjusted returns, not just the biggest number on the screen.
Risk adjusted, okay. How does that play out?
It means investors are comparing yields not just within crypto, but against traditional stuff too: bonds, high-yield savings, even real estate sometimes. They want a good reason, adjusted for risk, to put their capital into staking.
So digging deeper into where the yield comes from.
Exactly. Where does it actually come from? Is it network transaction fees? Is it inflation built into the protocol? Or is it just temporary subsidies designed to attract liquidity? They want to tell the difference between real sustainable income and just, token emission schemes. The focus has shifted from how much to how sustainably and how safely can I earn this?
Makes sense. And the third pillar, flexibility. You said this is huge now.
It's become almost non-negotiable.
Yeah.
Think back to early staking. You often had these really restrictive, long lockup periods, sometimes years, and absolutely no way to touch or use your staked funds during that time.
Yeah, that's a deal breaker for many.
Totally. That level of illiquidity, it's just a non-starter for most modern investors, especially the big institutional players or even just active retail folks. People want to earn passive income, sure, but they also want the option to react fast if the market moves, or use their assets somewhere else in DeFi, or just pull their capital out if their own situation changes.
So they want their cake and eat it too, basically. Earn yield, but stay liquid.
Pretty much. And the market's responded. We've seen some truly groundbreaking innovations that tackle this head-on, completely changing how people think about capital efficiency and having options in staking. So yeah, these three together, robust security, sustainable yield, and that crucial flexibility, they define the modern staking landscape. They're the filter investors use.
That trifecta really sets the stage.
Yeah.
And security being right up there makes total sense. If you're putting assets to work, job number 1 is making sure they're safe.
Yeah.
So let's talk about that first big choice, custodial versus non-custodial staking. How do these approaches fundamentally change the security picture for your staked assets? What are the real trade-offs?
Yeah, this distinction is absolutely critical. It's often the very first decision a staker needs to make. So custodial staking, we're mostly talking about services offered by the big centralized exchanges, right? Coinbase, Binance, Kraken, places like that.
The easy button, basically.
Exactly. The convenience factor is massive. You deposit your crypto onto their platform, kind of like putting money in a bank, and boom, usually just a few clicks, and they handle everything. All the tech complexity managing the validators.
Validators being the network participants doing the work.
Right. The ones processing transactions, securing the blockchain. The CEX deals with network upgrades, potential slashing issues, distributing rewards. It's totally hands-off for the user.
Sounds great. What's the catch?
The catch is what we call custody risk. When you use a custodial service, you're fundamentally trusting that third party with your assets. They hold your private keys.
The keys, not your
Not
keys.
your crypto. Exactly. You don't actually control your coins directly. So if that exchange gets hacked or goes bankrupt, and we've seen that happen, unfortunately, or if they face some regulatory action that freezes assets, well, your staked funds could be in serious trouble, maybe inaccessible, maybe even gone for good. You've basically traded direct control and sovereignty for that convenience. It requires enormous trust in that central provider.
Okay, so what's the alternative? Non-custodial.
Right. Non-custodial staking. This usually involves decentralized protocols, think Lido, Rocket Pool, or maybe even running your own validator or delegating through a non-custodial pool. The key difference, you keep control of your private keys the whole time.
So my keys, my crypto.
Precisely. You always have true ownership of the underlying assets. You interact directly with smart contracts on the blockchain to stake your crypto. Smart contracts being those self-executing bits of code, right?
Yeah.
This gives you much greater control and totally eliminates that counterparty risk from a centralized company failing.
Sounds much safer from that perspective. Is there a downside?
Increased control means increased responsibility. You are personally responsible for keeping those private keys safe. That means using hardware wallets, storing seed phrases securely offline, following all the security best practices meticulously.
If you mess up, it's on you.
Completely. Lose your keys, get them compromised, your funds are gone, forever. No helpline to call. Plus, you're interacting with smart contracts. And even though they go through rigorous security audits, there's always a chance, however small, of an undiscovered exploit or bug in the code itself.
So it's clear trade-off then. Ease of use with third-party risk versus total control, but more personal responsibility and smart contract risk.
That's it, exactly. Your own risk appetite, how comfortable you are with the tech, those are absolutely critical in figuring out which path is right for you.
Okay, so let's say you've picked your path. It's not just about who holds the keys, right? There are risks involved in the actual staking process itself on the network. I hear terms like slashing, and that sounds pretty bad. What are those inherent technical risks stakers face even if their keys are secure?
You're right, the journey doesn't start at custody. Once your assets are actively participating in the network's staking mechanism, there are definitely inherent risks. And yeah, slashing is the big one people worry about.
So what is it exactly?
It's basically a penalty the network imposes on validators if they misbehave. Misbehavior could be something serious like double signing, trying to validate the same block twice, which looks malicious or like a major error.
Okay.
Or it could be inactivity slashing, where a validator just goes offline for too long, not doing its job, which hurts the network's reliability. If the validator you've staked with gets slashed, the network destroys a portion of their staked capital, and by extension, a portion of your staked capital too.
Ouch.
It is an ouch,
Yeah.
but it's a crucial economic tool, right? It incentivizes validators to behave honestly and keep things running smoothly. It ensures the network's integrity and liveness.
Okay, what else besides slashing?
Well, there's simpler validator downtime. If your validator goes offline or just performs poorly for reasons not bad enough to get slashed, maybe their hardware fails, or they have internet issues or a software bug, you might just miss out on earning rewards while they're down. Your original capital isn't usually lost, but your yield pauses, which impacts your overall return.
So choosing a good validator matters.
Hugely important. You want ones with a strong track record, high uptime. And then there's the broader risk of smart contract exploits.
Even with non-custodial.
Especially with non-custodial, because you're interacting directly. These decentralized protocols run on incredibly complex code. And despite all the audits and testing, vulnerabilities can still exist. If someone finds an exploit and triggers it maliciously, it could potentially drain funds from the contract, affecting everyone who's staked through it.
We've seen that happen in DeFi.
Unfortunately, yes. The history of DeFi has plenty of examples. Reentrancy attacks, flash loan exploits. It underscores that this risk is always present, even with audited code. Understanding these risks, slashing, downtime, exploits, it's just crucial for anyone staking. Doesn't matter how techy you are, it directly impacts your potential returns and the safety of your investment. Helps you make an informed choice, not just chase a high APY blindly.
So the risks are real. But is the market developing ways to manage them? You mentioned this is a maturing space.
Yeah, absolutely. And this raises that important question, right? As staking gets more mainstream, how do we balance all this cool innovation and yield strategies with solid risk management? Thankfully, we're seeing solutions pop up.
Like what?
For one, specialized insurance solutions are starting to emerge in DeFi. Think of companies like Nexus Mutual or Insurus. They offer decentralized insurance cover specifically for staking risks, things like slashing, sometimes validator downtime, even certain kinds of smart contract
Do
hacks.
you pay a premium for protection?
Exactly. You pay a premium to mitigate some of those technical risks. It's still a pretty new part of the ecosystem, but it shows there's growing demand for these kinds of traditional risk management tools within DeFi. Lets investors fine-tune their risk exposure.
Interesting. Anything else?
Well, liquid staking derivatives,
Yeah.
LSDs, which we'll definitely dig into more later, they also play an interesting role here, sort of indirectly.
How so? Their main thing is flexibility, right?
It is, but they can also help reduce that perceived direct staking risk. See, when you stake through a liquid staking protocol, you typically aren't picking one single validator yourself.
Mhm.
Your assets get pooled and spread across a diverse set of professional, often vetted validators that the protocol manages.
Diversification.
Exactly. So the impact if one single validator messes up or gets slashed slightly, it gets spread across the whole pool. This potentially lowers your individual exposure compared to if you'd put all your eggs in one validator's basket, especially if that validator wasn't super reliable. It's like built-in risk pooling provided by the protocol.
Okay, that makes sense. But here's where things get really interesting, I think, where technical security bumps up against like regulatory security. Because the rules can change, right? And that can hit even the biggest players. The whole Coinbase situation with the SEC over staking really highlights this, doesn't it? Reminds us that security isn't just code, it's compliance too.
It absolutely does. That Coinbase case is critical, and it sent ripples through the whole industry. The SEC scrutiny they faced in 2023, 2024 over their staking as a service. It's a powerful reminder that regulatory risk is a whole separate major factor, especially for centralized players.
What was the SEC's argument?
Essentially, they argued that Coinbase's staking service was an unregistered security. They looked at it through the lens of the Howey test, this long-standing legal test. They said, look, Coinbase is pooling investor money, they're managing it on behalf of investors, and they're promising a return. That, in their view, fits the definition of an investment contract, which needs to be registered as a security.
Wow. So it wasn't just a fight for Coinbase.
No, it cast a shadow over all centralized staking providers. It really highlighted how uncertain and, frankly, still evolving the regulatory landscape is for crypto, especially in the US. It hammered home the risks tied to centralized services. Regulators can step in, disrupt things, slap on big penalties, maybe even force services to stop. That directly impacts users and their funds.
Right, if they halted staking.
Exactly. Or even heavy fines could make the business model unviable.
What were the broader ripple effects?
Huge implications for how crypto interacts with traditional finance. It forced everyone to reevaluate what counts as a security in the digital asset world, not just for staking, maybe for other yield-generating stuff too.
Yeah.
It definitely made other centralized companies think twice about how they offer similar services, maybe pushing them towards more decentralized models or making sure they're incredibly buttoned up on the regulatory side.
Did it boost the decentralized options like Lido or Rocket Pool?
Arguably, yes, indirectly, because those non-custodial protocols where they don't hold your keys and operate via code, they aim to be structured in a way that's less likely to be classified as an investment contract run by a central entity. So, for investors, the Coinbase situation was this stark reminder. Even big, seemingly safe platforms can face unexpected regulatory headwinds. It adds another layer of risk you have to consider beyond just the tech. Security analysis has got to be multifaceted.
Okay, so we've navigated the security maze, thought hard about custody. Now let's get to the part everyone loves to talk about, the yield. Where are the returns actually coming from in 2025 across this whole crypto space? Let's start with the big one, Ethereum staking. It's the benchmark, right? What's the sort of new normal for ETH yields now, and how does it stack up?
Yeah, Ethereum staking is definitely the reference point for a lot of people in proof of stake. And what we've seen, especially since all the activity around the merge and the Shanghai upgrade, is a real normalization of yield.
Normalization meaning
Lower.
lower.
Generally, yes, compared to maybe some earlier, more speculative phases. After Ethereum successfully switched to proof of stake and, crucially, allowed staked ETH withdrawals with Shanghai in 2023, there was an adjustment period. Now, in 2025, ETH staking yields are typically hovering in the, say, 3% to 5% APY range.
Okay, 3–5%. Why did it settle there?
A couple of main reasons. First, just the sheer amount of ETH that flowed into staking after the merge. You have way more validators now, all competing for the same pool of block rewards and transaction fees. More validators means the rewards get split more ways, so the reward per ETH staked naturally goes down.
Makes sense. Supply and demand.
Pretty much. And second, the Ethereum network itself has just matured a lot. You know, those super high yields you sometimes see on brand new networks, they tend to stabilize as the protocol proves itself, becomes more secure, efficient, robust. It's just a sign of the network growing up.
So how should listeners think about that 3-5% compared to other things?
Well, look, 3-5% APY might not sound like those crazy triple-digit returns from early DeFi days, right?
Definitely not.
But it looks incredibly compelling when you compare it to traditional low-risk investments. Think about a typical high-yield savings account. You might be lucky to get 0.5%, maybe 1%.
Yeah.
Government bonds might give you 2-4%, but often you have to lock your money up for longer.
Okay, so relative to TradFi, it's attractive.
Very attractive.
Yeah.
Ethereum staking offers a solid, relatively stable income stream from what's considered a blue-chip crypto asset. It helps position ETH as a productive asset that can also appreciate in price, not just something you speculate on. It's a more mature, reliable way to generate income in crypto, which appeals to a broader group of investors, maybe more conservative ones, looking for consistent returns.
That makes a lot of sense for a foundational asset like ETH. Stable, predictable, but maybe not thrilling for everyone, right?
Mm-hmm.
For those looking to really boost returns beyond that base ETH yield, what are the more advanced strategies people are using in 2025? I keep hearing about things like restaking and this whole LSDFi world.
Ah, yes. This is where the real cutting-edge innovation in yield generation is happening right now. It offers some really compelling stuff for people willing to handle a bit more complexity and, importantly, layered risk. You're right, the big buzz is around restaking and the expansion of the LSDFi ecosystem.
Okay, break down restaking for us. EigenLayer seems to be the big name there.
It absolutely is. EigenLayer has basically pioneered and driven the massive growth in restaking we saw in 2024 and into 2025. The core idea behind restaking is actually quite brilliant in terms of capital efficiency. It lets you take ETH that's already staked, or, more commonly now, liquid staking derivatives like Steth, and repledge it or rehypothecate it to help secure other decentralized applications.
The applications.
Yeah,
Like,
these are often called actively validated services, or AVSs. Think of them as separate blockchain modules or protocols that need their own economic security, but maybe you don't want to bootstrap a whole new token and validator set from scratch. Examples could be decentralized Oracle networks, new data availability layers, which are super important for scaling solutions like rollups, maybe decentralized sequencers for layer 2s, even new kinds of virtual machines.
so my staked ETH secures Ethereum and something else.
Exactly. Your staked ETH or LSD is already earning you base rewards for securing Ethereum. With restaking, say through EigenLayer, you commit that same capital to also provide security for one or more of these AVSs. And by doing that, you earn additional yield, often paid in the native tokens of those AVSs.
Ah, so you're stacking yields.
You're stacking yields. It creates this layered security model. One underlying asset generates compounded returns from multiple sources. EigenLayer lets you do this without unstaking from Ethereum itself. It's been a huge driver of new revenue streams and how capital gets used. People talk about it creating a shared security model for Web3.
Sounds powerful. Is there a catch? More risk.
Definitely layered risk. If an AVS you're securing messes up and gets slashed according to its own rules, your restaked ETH could get penalized. So you could face losses related to the AVS on top of any potential risks from your primary Ethereum staking. It's risk on top of risk.
Okay. And the other term you mentioned was LSDFi.
Right, LSDFi.
Oh.
Short for liquid staking derivatives finance. This is basically the whole booming DeFi ecosystem that sprung up around LSDs. Remember, LSDs are liquid tokens representing your staked assets plus the rewards. They don't just sit there idly.
Right, they're usable.
Hugely usable. That's the key to capital efficiency. You take your Steth, for example, which is already earning you that 3-5% staking yield. You can then deploy it further in DeFi.
Like how?
Well, you could use it as collateral on a lending platform like A or Compound, borrow stablecoins against it, maybe use those stables for other investments, or even buy more ETH to stake, again leveraging up your position. Or you could provide your LSDs as liquidity on a decentralized exchange, a DEX like Curve or Uniswap. Pair your Steth with regular ETH, for instance. Then you earn trading fees from people swapping between them on top of your staking yield, plus maybe some extra incentive tokens the DEX offers for providing liquidity.
Wow, so multiple layers of yield again.
Exactly. These are all ways to generate more yield, layering strategies on top of your initial stake. It creates this powerful synergy between core blockchain security and the broader DeFi world. If you connect it to the bigger picture, restaking, and LSDFi, they represent this fascinating evolution in how capital gets used to secure multiple networks and generate multi-layered returns. It might be a whole new paradigm for passive income in Web3. But, again,
More layers of risk.
definitely. The more protocols your asset interacts with, the more potential points of failure or exploit you're exposed to. Technical risk, economic risk, it all gets layered.
That makes sense. It sounds like a powerful engine for returns, but it brings back that classic saying, right? Higher returns often mean higher risk. So what about looking beyond Ethereum, those smaller alternative layer one chains? Do they still offer those really eye-popping yields that attract some investors? And what's the trade-off there?
You've hit on a really critical point every investor needs to weigh up. While Ethereum gives you that more normalized, stable yield, yes, smaller alternative layer ones absolutely can offer significantly higher yields. But they usually come with a matching increase in volatility and underlying risk.
Which chains are we talking about?
Think about networks like Avalanche, AVAX, maybe some newer ones. These chains often have smaller market caps, fewer validators running the network, and they're still actively trying to incentivize people to join in, secure their network, and build their ecosystems.
So they pay more to attract people.
Often, yes. For example, maybe in mid-2024, while ETH staking was doing 3.5%, you might have seen Solana, SOL, offering 6-8%, Avalanche, maybe 7-10%. And newer chains, maybe in the Cosmos ecosystem or near, could offer 10-15%, sometimes even higher for specific assets. They're competing hard for capital and developers, and high staking yields are a key weapon in that fight.
Okay, but what's the deeper analysis? Why is it higher?
Often, that higher potential return is basically compensation for taking on more risk. Smaller L1s can be way more volatile in price. If you earn a 12% staking yield on a token, but that token's price drops 30% while you're staking, you still lost a lot in real dollar terms.
Right, the token price matters hugely.
Hugely. That's why understanding the correlation of staking yield versus token price is so important. A high yield doesn't automatically mean better returns. Sometimes it's just needed to lure stakers to a riskier asset, or maybe to compensate for low transaction fees on the network. It's rarely a free lunch.
What other risks?
These networks might have a less mature security setup, fewer smart contracts that have stood the test of time, maybe a smaller developer community compared to Ethereum. So while the yield percentage looks tempting on paper, you absolutely have to dig into the token's price stability, the network's long-term prospects, the overall market feeling about that specific asset. It's that crucial trade-off. Chase higher potential returns, but accept higher volatility and potentially more technical, market, or even governance risks compared to the established players like Ethereum.
So it really puts investors in a tough spot, doesn't it?
Yeah.
Balancing that ambition versus caution. Would you rather stake for a relatively safe 4% on Ethereum or go after 15-20% plus on smaller chains where the risks are clearly higher? It's a genuine dilemma.
It absolutely is. And there's no single right answer, right? It comes down to your personal risk tolerance, your investment timeline, your financial goals. The key is understanding why the yield is higher. Is it from real protocol earnings? Or is it mostly funded by inflation printing new tokens, which could dilute the value of your holdings over time? That analysis is vital for making smart decisions.
And looking ahead, are there even newer frontiers for yield opening up?
Definitely. We're starting to see the early stages of Layer 2, L2, staking and restaking. L2s like Arbitrum, Optimism, ZK Sync, Polygon, they're growing incredibly fast, and this is paving the way for staking opportunities directly on these scaling networks.
Staking on an L2, how would that work?
Well, imagine a future where you don't just stake ETH on the mainnet, but you could also stake assets directly on an L2 to help secure its specific operations. Maybe help run their decentralized sequencers, or secure bridges between the L2 and L1, or even restake L2 native tokens to secure apps built only on that L2.
Wow, okay.
It could further decentralize things, diversify where staking happens, maybe offer new yield streams with the benefit of lower fees and faster transactions that L2s provide. It's still speculative, but it's an exciting direction. It suggests staking could become even more integrated into this whole modular blockchain stack, letting you customize your risk and reward even more granularly across different layers.
This flows perfectly into that third pillar investors care so much about now.
Yeah.
Flexibility. Because, let's be real, the idea of locking up your valuable crypto for months, maybe years,
Yeah.
watching the market go wild while your funds are stuck,
Right.
unable to react or use that capital, that's a massive turnoff for so many people.
Yeah.
And this is where liquid staking derivatives really step in, right?
Yeah.
Here's where it gets really game-changing. Imagine earning those staking rewards consistently, but still having access to your capital, being able to use it elsewhere in DeFi. That feels like the magic trick of LSDs.
That's it exactly. You've nailed the revolutionary core. Liquid staking derivatives, LSDs, they are an absolute game changer for flexibility. And honestly, for the whole staking and DeFi ecosystem, we've mentioned them, but yeah, let's dive deep because their impact is profound.
So what are they, fundamentally?
They're basically synthetic tokens, Steth from Lido, MSOL from Marinade on Solana, RETH from Rocket Pool, CBETH from Coinbase. Their core value proposition is revolutionary. Earn staking yield without locking up your underlying asset. It solves that massive historical pain point of traditional staking.
How does the magic trick work, the mechanism?
It's actually pretty clever. When you stake your crypto, let's say ETH, with a liquid staking protocol, you don't lock it directly into an Ethereum validator in a way that makes it totally inaccessible. Instead, you deposit your ETH into the protocol's audited smart contract.
Okay.
In return, you immediately get back an LSD token, like Steth. This Steth token represents your original staked ETH plus all the staking rewards that automatically build up over time. And the crucial part, this LSD token is liquid.
Meaning I can trade it.
You can trade it instantly on decentralized exchanges, you can sell it, or most powerfully, you can use it as collateral or liquidity in tons of other DeFi apps, all while your underlying ETH, represented by that token, is still earning staking rewards back in the protocol's validator pool.
So it completely decouples staking rewards from being illiquid.
Totally. It provides unprecedented capital efficiency. You get the yield without the lockup. And this directly tackles that huge historical barrier, the lockup period and the opportunity cost that came with it. Before LSDs really took off, and especially before certain network upgrades, staking meant accepting your funds were stuck for potentially years. That uncertainty, that lack of control, it scared off a lot of people, especially bigger players.
But LSDs reduce that risk.
Substantially. And now, some protocols are going even further, offering instant unstaking options. You can sometimes swap your LSD back for the original crypto almost immediately, maybe by paying a small fee or using a special liquidity pool designed for quick exits. It just further reduces friction, getting closer to true on-demand liquidity.
You mentioned network upgrades being key. That Ethereum Shanghai upgrade in 2023, that must have been massive for this whole LSD concept, right? Finally knowing you could actually get your staked ETH back.
Oh, absolutely monumental. Shanghai, April 2023, that was a watershed moment. It fundamentally reshaped staking and really poured fuel on the liquid staking fire. By finally enabling staked ETH withdrawals, both your initial stake and the rewards.
It answered the big what if.
Exactly. It removed that ultimate lockup risk that had hung over Ethereum stakers since the beacon chain first launched back in late 2020. Before Shanghai, you staked ETH, and there was no guaranteed date you could get it back. It was locked until whenever the upgrade happened. That uncertainty, while okay for early believers, was a huge roadblock for wider adoption.
So Shanghai unlocked confidence.
Massively. It gave stakers a clear path, even if sometimes queued, to get their assets back. Investor confidence soared not just for people staking directly, but even more so for the liquid staking protocols. Suddenly, their LSDs represented an asset that was verifiably redeemable for the real thing.
And the data showed that.
Clearly. Post-Shanghai, the amount of ETH staked via liquid staking protocols just exploded. The total value locked, TVL, in protocols like Lido shot up. It was like a massive de-risking event that unlocked a huge wave of new capital. It turned previously illiquid staked ETH into this flexible, redeemable asset, empowering a whole new wave of stakers. And what's truly fascinating now is how these LSDs have gone beyond just being yield tools. They've become fundamental building blocks in DeFi, letting people layer strategies, maximize capital efficiency, really showing off that composability power of Web3.
Composability meaning using them like money Legos.
Exactly like money Legos. This is where the advanced use cases shine. Sophisticated traders aren't just holding Steth for the 4% yield, they're actively using it as collateral everywhere.
Give me an example again.
Okay, take your Steth, already earning yield, deposit it into Avi or Compound, borrow stable coins against it, use those stables for another investment, maybe buy more ETH to stake, maybe farm yield somewhere else. You're leveraging up.
Or providing liquidity.
Right, put your Steth into a liquidity pool on Curve, maybe paired with regular ETH. Now you're earning staking yield, plus trading fees from the pool, plus maybe extra rewards from Curve.
So your capital is working in multiple places at once.
Simultaneously, it creates this incredibly rich, interconnected Web3 financial system where assets aren't static, they're dynamic, working across multiple protocols. That's the power. But again, layering strategies also means
Compounding risks.
compounding risks. You're now exposed to potential issues, smart contract bugs, liquidation risks, impermanent loss across multiple protocols. The gains can be amplified, but so can the potential losses.
Okay, that makes perfect sense for maximizing capital. But it does raise that really important question about concentration, about the core idea of decentralization. When one player gets too big, it rings alarm bells, right? So are LSDs definitely the future of DeFi? Or could this just be another bubble? And what about one player like Lido, controlling over 30% of all staked ETH? That feels significant.
It is significant, and that's an absolutely crucial point. It's a debate raging right now within the Ethereum community and wider crypto space. Lido's huge market share, yeah, over 30% of staked ETH, it's impressive from a product perspective, shows they found product market fit, had that first mover advantage.
Right.
But it absolutely raises serious questions and concerns about centralization within the Ethereum ecosystem.
What's the core concern?
The worry is, if one single entity or protocol controls such a massive chunk of the staked ETH, could it potentially exert too much influence over the network?
Influence how?
Well, potentially influencing decisions about validator set rules or upgrades, maybe even theoretical risks around transaction censorship, though that's super complex and debated. Or, in a really extreme scenario, if that single entity or its core infrastructure got seriously compromised, could it impact the network's liveness, its ability to keep running?
Even if Lido is a DAO.
Even with a DAO structure. For a network like Ethereum, where decentralization and censorship resistance are core values, this concentration is a genuine concern. If you look at the LSD dominance metrics, comparing Lido to Rocket Pool, Frax, even the centralized exchanges, Lido's lead is massive.
Yeah, you said Rocket Pool is much smaller.
Right. Maybe around 3–4% market share compared to Lido's 30% plus DO. Centralized exchanges also hold a big chunk collectively. This concentration is a valid challenge to the network's long-term health and decentralized governance. The fear isn't necessarily that Lido will do something bad, but that having such a large concentration creates a potential single-point failure risk, maybe, if most validators under Lido use similar software, or if the DAO governance itself becomes too centralized.
So back to the question.
Yeah.
Future or bubble?
Yeah.
And how do we deal with this?
Well, in terms of bringing flexibility, efficiency, and wider access to staking, LSDs feel like the future. Their utility is undeniable. They've transformed DeFi, but that decentralization question has to be addressed. We need healthy competition. Protocols like Rocket Pool are specifically designed to be more decentralized, letting anyone run smaller mini-nodes. Frax ETH has its own unique model. These alternatives are vital. We need them to thrive to ensure the benefits of liquid staking don't accidentally erode the core principles, security, censorship resistance, decentralized governance that make Web3 valuable in the first place. It's a constant balancing act, something the community needs to keep monitoring and working on.
Wow, we have covered a ton of ground, from how staking evolved to balancing security, yield, flexibility. But let's zoom out one last time, bring it all together. Why does staking really matter so much in 2025? It feels like it's way beyond just, crypto traders trying to make a quick buck now.
Oh, absolutely. It's moved far beyond that, and its importance today really can't be overstated. One of the clearest signs of staking's maturity and why it matters so much now is the huge rise of institutional adoption.
The big money is getting involved.
Definitely. We're seeing a clear, accelerating trend. Big hedge funds, asset managers, corporate treasuries, even sophisticated family offices, they are actively engaging with staking now. And these aren't the early speculators. These are serious players demanding very specific things.
Like what?
They need compliant, secure, and super flexible staking products. Stuff that fits into their existing regulatory boxes, provides clear reporting for audits, and crucially, gives them the liquidity to manage portfolios in fast-moving markets. If you look at research from firms like ARK Invest, Coinbase Institutional, Fidelity Digital Assets, it all points to this growing, sustained appetite for staking yields from traditional finance.
So what does that signal for the bigger picture?
It signals a profound maturation of the whole crypto market. It shows crypto integrating more deeply with traditional finance. Institutions aren't just buying Bitcoin as a speculative bet anymore. They're actively participating in the underlying economic machinery of these networks to generate income, diversify, improve capital efficiency.
It validates crypto more broadly.
Hugely. It provides significant validation for the asset class and for staking as a legitimate way to earn income. It moves staking further away from being seen as just risky speculation and towards being a recognized financial activity. This institutional embrace. It's a massive signal about crypto's long-term viability and its growing role in global finance.
Okay, so that's the institutions. But what about for individuals? For the retail investors, our listeners? Beyond the tech and the big players, what's the core lasting appeal? Why are regular people still drawn to staking?
For retail investors, the appeal remains incredibly strong, especially when you look at the wider economy. Staking offers a source of what you could call stable yield, relatively stable anyway, given crypto's volatility in what's often a pretty uncertain economic climate with inflation worries and low interest rates elsewhere.
An alternative to low bank rates.
Exactly. Traditional savings accounts might offer next to nothing, sometimes less than inflation. Bonds give moderate returns. Staking presents a compelling and, importantly, accessible alternative for passive income. It kind of democratizes yield generation.
How so?
Well, for you, the listener, it's a tangible way to make your crypto holdings actually do something, earn for you, like getting dividends on stocks or interest from a bank, but often with potentially higher returns, especially if you're staking on chains with growth potential. It makes earning in crypto less about just guessing price moves and more about actively participating in a network's economy and getting rewarded for it.
So it encourages a longer-term view.
It definitely can. Staking often incentivizes holding assets rather than constantly trading, which aligns your interests with the long-term health of the network you're supporting. And connecting this back to the really big picture, staking isn't just about you getting returns, it's absolutely fundamental. It underpins the security and the whole economic lifeblood of the Web3 ecosystem. It's truly the engine.
Yeah, was it the engine? Two main ways.
Two crucial ways. First, network security. We talked about proof of stake. Stakers, whether running validators or delegating, are the ones verifying transactions, proposing blocks, keeping the blockchain honest. By locking up their capital, they put skin in the game. It creates this massive economic incentive to act correctly and secures the network against attacks. Without a strong, active staking community, these networks just wouldn't work securely or reliably.
Okay, security is number one. What's number two?
Number two is fueling DeFi activity, especially through liquid staking assets, those LSDs. We saw how they act as collateral, provides liquidity to trading pools, serve as those money leddos in DeFi. It creates this powerful loop, right?
A symbiotic relationship.
Exactly. Staking provides the secure base layer and the initial yield. Then LSDs inject that value and liquidity into the wider DeFi world, powering lending, borrowing, trading, all sorts of innovation. You just look at the growth in things like EigenLayers, restaking TVL, or the constant expansion of LSDFi products. It shows this deeply interconnected system. Staking isn't just a feature of Web3, it's foundational. It allows this whole composable, evolving financial landscape to function and grow.
So wrapping it all up, what does this mean for the future of decentralized finance, for how we all interact with our digital assets? It really sounds like staking, from the simplest form to the most complex restaking stuff, is just deeply woven into the very fabric of Web3 now. Hashtag tag tag outro. Wow. What an incredibly detailed and a really insightful deep dive that was.
Yeah.
We kicked off talking about that crypto buzz, right? And that desire we all feel to make our digital assets actually productive. Then we traced staking's journey from this obscure niche thing to a total mainstream powerhouse. And we saw how that shift is all about investors now demanding that trifecta: solid security, sustainable yield, and absolutely crucial flexibility.
Yeah, that balance is key.
We got into the weeds on custodial versus non-custodial staking, the real technical risks like slashing and exploits, but also how things like insurance and LSDs themselves are helping manage those risks.
Right, the mitigation strategies are evolving too.
Then we toured the yield landscape, from Ethereum's more stable base rates to the supercharged returns possible with restaking and LSDFi, and those higher risk, higher reward plays on smaller L1s.
A diverse set of options.
And finally, we really grasped the power of flexibility that LSDs unlock, how they freed up state capital, but also the really important decentralization questions that come with their dominance, especially someone like Lido.
It's a landscape that's just constantly innovating, constantly changing. And as staking keeps evolving so fast, especially with restaking getting more sophisticated, layer 2s getting integrated, what new risks, maybe ones we haven't even thought of yet, and what new opportunities might pop up in this relentless search for the best yield and the most flexibility? And maybe more fundamentally, how will all these changes, these tech and financial developments, ultimately shape that core decentralization ethos of Web3 itself, the very thing that underpins everything we talked about today? That's a huge question, something for all of us to really think about and keep exploring as this space keeps rewriting the rules of finance.